Hey everybody, welcome back to our weekly live event. This week is really special. We have Kyle coming on. He's actually 21 years old, and he owns 119 units. So it's going to be a really great interview. We're going to get into picking his brain and seeing what he's done through the years, how he's done it, and kind of hear directly from him what got him into the business and all the other great questions. I got your questions on here from the last post I submitted on IG. So we're going to be asking those questions. Kyle, you're going to see, yeah, there we go. All right. All right, we're waiting for Kyle to log on and hear it direct from him how he got to 119 units. What's up, Kyle? How you doing?
Good, man. This is cool. I've never done this before.
Oh, you haven't? This is good. I do it twice a week. I do it on IG and YouTube, where I go and answer Q&A questions on how to invest in real estate, personal finance, and business. I've done it for since I was 19, so I've been giving people advice and teaching them along the way. So, but you're 21 and you have 119 units. So how does that feel?
I guess it just feels normal for me. I don't know. I haven't really been able to conceptualize it at all. It's just going about my day regularly and, still wanting to do more. So I'm not necessarily satisfied, and I guess it really hasn't sunk in yet either, to be honest.
Awesome. Awesome. It's definitely a good way to think of it and to be. That way just kind of like continue going and push it along. So, so tell everyone a little bit about yourself kind of before we dive into like the questions.
Yeah, so I was actually a student at UC Davis. I was playing Division I soccer out there and studying pre-med as well, and just looking for a way to kind of make some money independent of my time, because as a Division I athlete and a pre-med student, you don't really have any free time. And I realized that even though I was doing what everyone said that I was supposed to be doing, and I was supposed to be viewed as successful in that role from the outside, I didn't feel successful and I didn't feel satisfied. So I wanted to find something that I could be actually passionate about and that could also run independent of my time, so I didn't have to be somewhere constantly working. And I ended up reading Rich Dad Poor Dad my sophomore year of college, and kind of changed my perception and put words to the feelings that I had. And I was like, okay, real estate makes sense. I'm going to follow this thing. And about a year later, I ended up doing the 107 unit and then the 12 unit, and was able to drop out of school. And this is what I do full time now.
Awesome. Awesome. So you actually did the 107 unit first, then you did the 12 unit.
Yeah, as weird as that seems. And the funny thing, again, to be counterintuitive, the 12 unit's actually a lot harder to run than the 107 unit, just because of the scale. And I almost wish I didn't do the 12 unit. I wish I just had the 107. But yeah, that's kind of how it is in real estate, man. It's very counterintuitive. Commercial real estate, the bigger you go, the easier it is, which is one of the weirdest things you'll learn, but that is actually very true.
That's a really good point, because one of the things I teach everybody on my page is that you don't want to do a condo and you don't want to do a house. Now, you'd think a condo is going to be easy or a townhouse is going to be easy because the maintenance is done for you. But in the reality, to actually cash flow and be profitable, it's extremely difficult. It is easier to do a 4-unit building than it is to do a single unit. And as you said, as you grow, the bigger projects become easier and easier. I just did a 16-unit, and that's as easy as it is to remodel a single house. It's just counterintuitive.
Yeah, exactly.
So what were the issues, kind of just to stick on the topic, what were the issues that you encountered that were different between the 100 unit compared to the 12 unit?
Well, first off, the level of professionalism amongst the management company that you hire. So for the 107 unit, we're getting the best management company in Louisville, which is where the property is located. They have 4,000 units in the market. They only do multifamily. This is their specialty. They run 100, multiple properties just like the one that we're asking them to run. So it's right in their wheelhouse. They already have all the systems in place, and it's kind of like a smooth sailing with them. In the 12 unit, we had to hire a residential manager who, this is their biggest property, and they don't really fully understand the NOI valuation of commercial real estate. They're just kind of, we had to teach them how to stay in the budget. And it's just kind of really difficult to coach someone who's in the single family space that, hey man, you can't go over the budget. That completely messes up our 5-year pro forma. You have to stay like, as much as it doesn't seem like it's a big deal, it is actually a pretty big deal to go over budget on a monthly basis. So that's the number one difference, is just the management company.
I try to explain to my followers that For every $100 you save per month, or $100 you increase the rent per month, on at least in residential deals, because the cap rates are different than commercial deals, it ends up being about $15,000 in increased value. So if they're off by $100, that's $15,000 that you lost in resale value. And if you take it over 100 units or 12 units, $100 times 12, that's what is that? $180,000.
Exactly. So it's a big deal. Yeah.
Yeah, it's a big deal. So yes, I definitely hear where you're coming from. So obviously, how did you start? Because a lot of people you're gonna find on Instagram, they'll be like, "How did you start? What did you do?" So what was your start?
Yeah, so I actually ended up starting with absolutely no money. I'm even seeing some of the comments in the live stream that you must have rich parents. I actually don't. My dad cleans pools and my mom's a yoga teacher. So I grew up very middle class. The only way I could afford school was getting the soccer scholarship. So I wouldn't have been able to go to college otherwise. And it definitely didn't grow up very rich at all. I had no money to start. The way I started was I actually went and joined a local meetup. The first time I went to the meetup, I told the guy how I found it. So I gave him some valuable feedback on his marketing. The second time I went to the meetup, I brought a friend, and that's adding value and bringing people to this meetup. The third time I went, I asked him if I could help with some of the tasks, sign people in, give name tags out, do some of the social media, schedule hosts. And then, I did that for months and months. And then I came back, and after that, I'd added value over time, built a relationship. I said, "Hey, can I speak on stage for 10 to 15 minutes about multifamily?" And as soon as I got on stage with a microphone, people were like, "Okay, this kid's an expert," instead of me just being a kid, right? You immediately are viewed as an expert when you have the mic, you're on stage. And that helped me to get a lot of meetings from that meetup outside of it, and coffees, lunches, and started to tell people what I had learned about multifamily and how valuable it was, especially on the tax benefits for W-2 employees, which most of these people were. They're wealthy lawyers and things like that who I'd met. And you have a huge six-figure tax bill if you're a wealthy W-2 employee, and if you invest in multifamily passively, you can potentially offset that entire tax burden, and then you're making actually all of your income for once, which is a huge value add. So just sitting down and having meetings with people like that. But I actually raised all of the money for those deals from outside passive investors that I'm not related to and that I didn't know previously. So that is definitely, if you don't have any money and you have no rich parents, you can still get started. You just have to know what you're doing. You have to put in the work.
So I want to touch on some topics you just said so everyone can kind of get the most value out of this. Is that the one thing I tell my followers often is that if you don't have money to pay someone to teach you, you have to go out and do something for free. This way, as you're providing a service to somebody, you're going to get something back out of it. So you can't automatically come in and just say, "Hey, I want this from you." These people are busy. Even if they wanted to give it to you, they don't have the time for that. But if you go and provide a value first, then you're going to be able to get something in return that they'll be happy to help you with, right? They're going to feel obligated to help you at some point. So what type of meetup did you go to?
So it was a local
follow-up question.
Yeah, so it was actually just a local real estate group meetup. They were predominantly in flipping and single family, which you'll find most of your local meetups are going to be centered around that. So if you can go and be the multifamily guy, it's a niche for sure. And, just speak for 10 to 15 minutes and kind of open people's minds, because flipping is a lot of transactional money. Most of the money that you make is, you put your time in and you get money out. And then also you're not reaping the tax benefits. You're usually paying capital gains. You are paying capital gains because you don't hold the property long enough, and it's sold for an investment purpose. So it's going to be capital gains taxed. So the whole benefit of real estate is long-term wealth, passive income, tax benefits, and appreciation. You're not getting any of those with flips. I mean, they're great. They make you money, and they're a lot of fun, and they definitely work. People are very wealthy in that space. But if you can give someone a different perspective and show them a different niche, it's super valuable for the group, and it's definitely valuable for you as well.
Yeah, I agree. Between your transaction cost of buying and selling the property and the tax you're paying, because the capital gain tax on a short-term hold is 35%, you've basically washed almost all of your profit. People don't realize that because they just see money, huge amounts of money moving in and out of their account. It feels cool. But at the end of the day, what they actually keep isn't that much money. So in reality, a lot of times people are like, "Why would you buy and hold?" Because my thing is I own 23 units by the time I was 23, and I did it with my own money. I didn't take any outside investors. And how I was able to do it is stick within the model. And you're able to do that if you're not flipping, because you're going to keep most of the money and you're going to collect the same amount of rent almost every year. So you're going to end up making that profit and not pay, basically, not only you're not paying any taxes, like you mentioned, the money you're bringing in from your W-2 or your business, you also don't have to pay on that tax either, because normally you have a depreciation to write that off. So yeah, that's really good that you're able to bring that message across to people, because a lot of people can't grasp that concept. It's a very difficult concept for people to understand and believe. So you met people at the meetup, and that's great. So, but what made you pick real estate compared to, say, all the other options?
So for me personally, real estate, just because that's the predominant focus of Rich Dad Poor Dad, which was the book that I read, that kind of opened my mind. And then I also just like the aspect of, real estate being a physical asset that I could understand. And it's almost its own business, right? You have your own control over kind of the performance of the property. You are, at the mercy of some sort of the cap rate in the market, or, things like right now, coronavirus, where people are potentially losing their jobs, so your occupancy is going to drop. But you can also control, how you buy that property and making sure that you have a 30% income buffer, which we do on most of the properties we have. So if 30% of the tenants move out because of coronavirus and losing their jobs, we can kind of offset that. And I have the control to go and not buy a property unless it has that buffer. And then while we're running it, barring massive pandemics like coronavirus, you're usually not even getting close to that buffer, and you're kind of just in control of your wealth. It's growing passively. It's appreciating over time. It's a great hedge against inflation. And it's pretty easy to wrap your head around because of the fact that it is a physical asset. It's not, stocks where you're just seeing numbers on screens and it's changing rapidly and there's algorithms involved. It's the building down the street. You own that and people live there. I mean, it's super great to wrap your mind around, especially when you're just starting.
Great point. And you actually went into my follow-up question, which was, how do you pick your properties?
Yeah, so I pick my properties basically market-wise. I'm always looking for job growth because, that's the main predictor of how much occupancy you're going to have. So I'm looking for not only job growth in just a positive metric, but also job growth in a diversified industry, like in diverse industries. So not just like there's a lot of small town cities, let's say Chattanooga, Tennessee, for example, where it's predominantly focused on the VW plant out there. So, if anything happens to the automotive industry, you're kind of slightly a SOL because your tenant base is going to be, massively impacted. Whereas in Austin, where I invest currently, there's a lot of tech for sure, but there's also diversified into education with the University of Texas. It's also diversified into manufacturing, and there's also some Amazon fulfillment centers and a lot of diversified industry, and it's just growing at a massive rate. If you look at the appreciation trend for the last 10 years in Austin, it's almost the best in the whole country as far as markets are concerned. And then when you go into the submarkets, we're obviously looking at more specific things like crime rate and other little metrics like that. But yeah, just really looking at job growth predominantly.
Awesome. So now so that's where you're picking your properties. Just so everybody knows, where do you live compared to where are your properties located?
I currently live in Austin. I relocated to be closer to the properties, but I did actually buy in Louisville and Atlanta from Sacramento, California. So you can do it remotely. That's the benefit of having these property management companies that we talked about earlier. The bigger you buy, the more professional you're going to get, and the more at ease you can feel with them running your property from a distance. But with that being said, we still do quarterly walks and surprise visits and make sure that things are running the way that they're said, because I definitely trust them, but you always want to kind of verify, trust but verify. So we do make it out there quarterly, but don't feel like you're shackled to investing only in the market that you live in. That's not necessarily fully true.
Okay, all right. So other than job growth and the environment that you're in, what is the initial cash on cash return you look for and the cap rate?
Yeah, so I'm not necessarily shackled to a cash on cash return, especially right now in the way that we are in the market. Cap rates, again, it depends again on so many different factors on where we can add value. Since in commercial, the way that my business plan is that we're trying to add value on that NOI. So actually, if you have a lower cap rate and you add NOI, you're actually going to see more of that on the back end, because the lower the cap rate, the more it's actually going to increase the value on the back end. So if you buy on a low cap rate and you're understanding that you're going to sell on a potentially higher cap rate, if you're understanding that you're going in, you're adding value, and you're going to sell, and that value is going to be realized in a greater volume because of the fact that you're at a lower cap rate, then you're actually going to reap the benefits of a low cap rate and a competitive market, which is a little bit counterintuitive again. But people say, stay on high caps, stay away from the low caps, it's overpriced. Well, not necessarily, because cap rate is it's a metric of value, but it's also a metric of risk. So risk and value are hand in hand. And the lower the cap rate, yes, the higher you're paying for the same income stream, but the risk is a lot different as well. So say a low cap would be center of LA. It's not that risky to buy downtown LA. It's the most populated city in America. So your risk is a lot lower than a 10 cap property in Davenport, Iowa. You know what I mean?
Yeah.
So cap rates aren't necessarily bad if they're low. If you have a business plan that can take advantage of a low cap, which is kind of what we're looking at, then it actually makes sense to buy on a lower cap. But it's just kind of a deal to deal thing for sure.
Understood. And now, and since I definitely understand that business model, because I do both models. I do one that's more of a cash flow model, and I do one that's more of an equity building. So I bought a couple of my last 2 properties. One was at like a 4 cap, I bought it at. And the other one I bought was at a negative cap, just because it needed so much value add. But obviously in the back end, you make a lot of money by buying in those good areas and adding the value. So if you're initially not aiming at cap rate and you're not aiming at cash on cash returns, what are you actually bringing in? What is your return on those type of properties that you say, okay, this is acceptable in the beginning, and then eventually we're going to grow this number by value add or better management or so on.
Yeah. So the entering metric usually for investors, as far as, since we're raising outside capital, the IRR or the internal rate of return, we usually look for something above 15%, just because that gets people interested. If you're not at that metric, then it's going to be hard to raise a substantial amount of money for the deal. And then as far as like a metric that we're really like stringent on and we focus on, and we're like, we will not buy this deal if it's not at this metric, that's usually going to be a DSCR, debt service coverage ratio. We want to make sure that we have that buffer that I spoke about earlier, an income buffer. So, yeah, at least 30%. So like a 1.3 to 1.35 DSCR, because we want to make sure, as far as returns are concerned, they're great, but they are speculative, right? Because you're taking into account assumptions for the future. And it's a 5-year future in most cases, 5-year to 7-year hold. So it's like, returns are great and I love them, and we try to be conservative with our projections. But at the end of the day, the thing that's going to save your business is can you pay the bank back? That's the main focus for us. Is if you can't pay the bank, the returns don't matter because the bank's taking the property, right? So it's like our focus is, let's make sure we're right with the banks, and let's make sure that no matter what, worst case, we're going to keep this property. And because I'd rather keep the property and be able to sell it and return people's initial principal than completely just lose everything that they've given me, So our main plan is yeah,
100%, yeah.
100%. So.
Oh yeah, for sure. Yeah. No, definitely. Like, again, yeah, it's, bears make money, bulls make money, pigs get slaughtered. Like, it's definitely important to not get greedy. And it's nice about most real estate people are not the greedy type. I found most real estate people are very religious, old school Christians, and they're not greedy, and they're very old school, and I like it, right? Because it's like, it's easy to understand and get along with. Recently, I've seen, like, every once in a while, the '08, and I think right now we're kind of there too. We have the group of the finance guys that are more of the greedy type and coming in, and they're bidding up prices to a point where it's like, this doesn't make any logical sense. Some of the deals other people are doing, and I'm just like, wow, okay, good luck. If this works for you, great, but I don't, because again, I have an accounting firm, I run numbers, I have an insurance agency also specializing in real estate investment. I've done a lot of things in the finance world and real estate world, and I'm just like, this doesn't make sense from any of the hats I've worn. So it's definitely important to be conservative and make sure that the number one thing is your investors. Make sure their money is safe. So what do you normally return? What is the normal return expected on your pro forma, on your projects?
So typically 15% or higher on the IRR. And then we also offer 8% preferred rate of return, which basically means that we don't make money until you make 8% on an annual basis. And then the split starts, and the split's 70-30 in favor of the passive investors. So we own 30% of the deal, but that 30% only kicks in after they've made 8% on their money on an annual basis. So it's kind of like a security blanket, right? That we're saying, no matter what, worst case, you're getting 8% or we're not going to make any money, right? So we're not going to do a deal unless we're confident that you're at least going to make 8% on an annual basis. And then 15 is the ideal. And usually, I mean, so far we've hit 15 every time, but we're setting the expectations at 8 because I'd rather under promise and over deliver than over promise and under deliver. Like the optics there just don't really lend themselves to people coming back and investing with you.
And this is the question to clarify. So I understand your IRR 15% and your 8% annual is on your preferred. Now, are you saying you're achieving the 15%? When you're saying you're achieving the 15%, are you saying that your investors are actually achieving 8% annualized, meaning in the sense of they're actually getting a 15% dividend, or are you paying out the basically 8% dividend from the rent, and then they're going to make the rest of their money on the back end when the property is sold?
Exactly, yeah. So they're hitting their 8% mark, and the income trend is trending with the 15% projection, and the cap rate is trending with the 15 IRR projection as well. Because IRR is a little bit complicated to explain without like a chalkboard because of the fact that it takes into account time value of money, which is an interesting thing, saying that $100 today is not worth $100 5 years from now, and taking that into factor, which is a little bit interesting. But yeah, they're on trend for the 15% as a whole encompassing IRR. The average annual return is somewhere around, I mean, if you average the whole deal, right, including sale year, then that statistic can get really slanted. If you look at the whole hold of the deal, your average annual return is somewhere around 20%. To put it in perspective, that's not 100% accurate, right? Because when you sell, there's such a huge chunk, and it makes that fifth year so big that when you average it against year 1 through 4, it ends up skyrocketing the average for the annual. So it's not necessarily, so it's hard to give you people a real metric. And that's kind of where the IRR comes in to kind of try to give it an all encompassing. But yeah, it's definitely difficult to quantify.
No, you did a really good job. You did a really good job. I mean, given that you've been doing this, how long have you been doing it for?
About a year and a half.
Yeah, you've explained it very, very well, because I've been doing this for a very long time, and I just wanted to clarify on exactly what you're saying, because some people don't explain it that well, and you did a really good job. So, yeah, so you're definitely you're doing good. You're definitely doing good. How difficult is it for you to find a deal that receives these type of returns at 100-unit level?
It's definitely very difficult, and it's definitely very competitive. We're currently under contract on a 90-unit in Austin, so that'll be the third deal I've found in a year and a half. That puts it into perspective. It's definitely difficult. You have to look at about 100 deals to find that one. That's typically what we've seen. And yeah, we've fallen out of a lot. Like we fell out of a 24-unit in Austin in January that I was really excited about, just because the rent roll didn't really make sense, and their T3 didn't really match their T12, and so we had to back out. And I'd rather not do a deal than do a bad deal. So I'm completely content to stay where I am and be patient and conservative, because at the end of the day, I'm 21 and I can take this nice and slow and make sure that I only do good deals. So right now I'm looking to do my third deal here at 90-unit in Austin, and we'll see how that goes. But again, we're taking it slow with this whole COVID-19 thing, so it's definitely changing our pro forma as well. So we have to recalibrate and see if we still want to do it.
Yeah. Now, would you say 9-unit or 90?
90, 90.
90. Okay, cool. Now, on your 90-unit or your 100-unit, what is the purchase price on those deals?
So in Austin, the purchase price is going to be a little bit different. It's at 111 a door right now, which just puts it at 10 million for the 90 units. Then in Louisville is about 42K per door, because it's more of a tertiary market. It's not quite as sexy as in Austin. So it was a $4.55 million purchase price for the 107 unit. And then in Atlanta, we paid just over $1 million for the 12 units. So on the same trend as Austin. But Austin right now, we're looking at potentially going back from the $10 million purchase price lower, closer in the low 9s, just because of the fact that, COVID's going to definitely change their T6, and their T3 wasn't great. And, we're just looking at, and also our lenders are a little bit frightened right now, as they, probably should be with the uncertainty. So we have to completely relook at the deal and see if we still want to do it.
Mm-hmm. And now, how did you find this deal? Are you actually, so you're searching, are brokers bringing you deals? Are you searching LoopNet? What is your strategy?
Yeah, so the strategy that I've come up with is I have a Chrome extension for my Gmail, and I send every broker on the LoopNet directory in Austin, Texas, who specializes in commercial real estate. I send every single broker a bi-weekly email, just following up and following up and following up. And I keep their information in a CRM, basically, what their family's names is, if their kids are involved in sports, if their daughter had a soccer game last week, and can I make a comment in the email referencing that, I'm actually paying attention to their life, right? And building this relationship. And so I've been doing that for almost a year with the broker that gave us this deal. So, I mean, I've been following the deal for so long that it's actually, I made a vision board for, New Year's. I know it's really follow up, because it's not even about the initial contact. It's about 6 months down the road. As this guy emailed me twice a month, every month for 6 months, like this guy definitely is a player. He's going to buy something. I should probably respond. It does take like, almost 4 to 6 months for them to take you seriously though.
I agree with you. It's definitely a follow-up game, and it is a long game. It's like a marathon. Really, really smart. It is, and another thing people don't understand, they think it's like a very transactional thing, but it is a relationship game, and it is a team sport at the same time. Everybody thinks it's like a single-player game. It's actually a team sport, which took me a really long time to get that. And I agree with your vision board part too. And if whoever doesn't know what a vision board is, it's basically a board that has up all the things that you would like to accomplish and that you would want in your life, and you keep on keeping. It basically helps you keep focused on it and helps you go and push for those goals. But my vision board is 20, 21, 350 units. So that's the thing I'm focusing on. That's my goal. And other crazy part is whenever you do that, you end up accomplishing your goal. That's what the awesome part is. It's like you really do accomplish your goal. And asking you shall receive, seeking you shall find. So this is really good. This is really good. I like how you're definitely very clear on what you want, what your metrics are, the type of thing you want to do, and your follow up to it is awesome. That's what's really good. Is your follow up's awesome, and it's going to basically shows that you're going to get there. The question is not an if, it's a question of a when. So that's what's awesome too to see.
Thank you.
So do you buy value add deals?
Yeah, I typically focus on value add deals. It makes the most sense in this market, and you can add a lot of value. It's probably the most profitable business plan you can have in multifamily. So I'm definitely interested in providing returns to a third party, private investor group. So you kind of have to do a profitable strategy, right? So value add is kind of the niche that I've found.
Awesome. And now, being in this business, there's obviously a level of value add you can do. You can do light or you can do heavy. What is your focus?
Definitely on the lighter end, for sure. We don't look at any structural damage. I think that the most important thing to take note of when you're doing value add is a lot of the value add doesn't actually show up on the back end, right? So we only try to do value add that's going to realize higher rents immediately. And that means the improvements that tenants can see and feel and touch, right? So that means new flooring, new appliances, things that they see and use on a daily basis, a new dog park on the outside, improving the landscaping of the properties, things that they can feel. Because if you're fixing the plumbing, or you're fixing you're changing the low flow toilets, or you're changing the foundation or fixing the roof, the tenants don't really feel that, and you don't get a rent increase. So that money is almost a sunk cost. It's not realized. It's not, there's no return on investment there. So we try to find deals that are going to be structurally sound, and then we can just add cosmetics to, and then realize higher rents because of it.
Awesome. Yeah, definitely agree on you. And especially with your business plan, it makes sense, because if you're doing heavy value add, you're not going to be able to achieve an 8% year one. Usually it's difficult to do that. So obviously everyone wants to know, how much did you raise for your first deal?
So I raised over $600,000 for the first deal. And I did that all from a local meetup in Sacramento. And yeah, I mean, it really is possible if you just put yourself out there and you just take, massive action, and you just keep doing uncomfortable things like, Instagram Live and things like that. You just got to keep putting yourself in positions where you can grow and you can be in front of people, and then, things happen.
I got a question. Okay, so you raised $600K for your first deal, but your first deal, from what I remember, was like $4.5 million.
Mm-hmm.
So don't you need to put down at least 20% on the deal?
Yeah.
How were you able to do that?
Yeah, so it is a team sport, like you said earlier, and I did have a partner, Eli, on the deal from the Wheelbarrow Profits Group. I met him in Jacksonville, and that's how we actually did the deal. So he brought a lot of the renovation costs and helped in the back end. And another thing to remember when you're raising capital is that you actually have to have a key principal, or someone that has the net worth to equal the loan that you're getting. So if we're getting a $3 million loan on this property, we need a partner who has $3 million net worth. And that's where the networking is huge, right? Because my dad doesn't have $3 million net worth. No one in my family does. I have to go and find that guy. And then he has to be willing to sign on the loan for it too. So you have to, keep that in mind too. You can't just raise capital. You have to also raise capital from hopefully at least one extremely wealthy person or just try to find someone who can equal that loan.
Got it. So you were able to raise 600, and that didn't count what your partner raised.
Exactly. Yeah. So the whole deal was about just a little bit over $1 million to raise.
Yeah, that definitely, that makes sense. It's a lot of people that's all right. So next question. How long is your normal hold period?
5 to 7 years.
5 to 7 years. All right. And so now kind of more a little bit off topic, but still within the same realm. What is your short-term and long-term goal?
So short-term goal this year would be to hopefully close 200 units. That would be ideal for this year. Then in the 5-year window, I'd love to be at 1,000 units. And then, hopefully in like the 5 to 10 year range, starting to get more into, giving back and being more on the coaching side of things. And not just for real estate coaching, but just, getting people financially literate, because I grew up middle class and my family didn't have an investment plan. We just spend all the money we make. That's how I grew up. And as soon as I learned that, it's really not that complicated to be an investor and to know what the wealthy do with their money, it changed my entire life. So I want to give that opportunity to other kids out there and adults who don't know either as well. So I'd love to be in a position where I can, educate people, whether that's going to schools or churches or doing, being a social media person and going and having, webinars where I can teach people this stuff. Either way, I just want to teach as many people about financial literacy as I can.
Awesome. That's a good goal. So now, basically you have the floor. I answered a lot of the questions. I'll go back to IG and see if there's more. But what do you want to add and say to everybody watching and that's going to be watching later?
I guess, regardless of your age or situation, there is definitely a way that you can achieve your goal, and it's just you have to set your mind to it and believe in yourselves. And I'd love to go through and answer some of these questions because there's some good ones here. David, I don't want to butcher your last name, so I'm not even going to go for it. But why 5 to 7 years? Could you explain that? Well, 5 to 7 years, IRR is a calculation based on time. So the longer that you hold, the less, your money is worth less over time, right? So your IRR is going to go down. But if you hold it for too short, then the IRR is a little bit skewed and the calculation doesn't like that either. So there's a sweet spot between 5 to 7 where you're going to actually make people the most amount of money possible. So the 5 to 7 purely comes from a calculation on returns so that we can give people the most money for their money. That's the whole reason it's 5 to 7. It's not magical other than that reason.
There's another question on there that said, what CRM are you using? And another one was, what's a T3 and T6?
Great question. So the CRM right now, I used Copper for a while. I highly recommend that to start for sure. And then what's the one I'm using?
Looks like he froze. Looks like he froze. Let's give him a minute to jump back on. I think so. What do you guys think?
All right, cool. I was checking the CRM, so I actually didn't realize that it would kick me off. But yeah, so didn't actually even see it, but it's Copper is probably the best CRM. And then a T3, T3 means trailing 3 months. So it's the last, if you look at a financial statement, it'll be in the form of months, usually, especially in real estate. So T3 means the last 3 months, the trailing 3 months from today. T6 would just be the trailing 12. So, yeah. Am I still here, by the way?
There?
Yeah, can you see me?
I see you, but your voice and your picture is not flowing.
Interesting. Is it better now?
Now it's back. That's good. It's
Okay,
good. Yeah, it's good enough.
cool.
Awesome. So if you didn't hear him, T3 is a trailing 3 months of financial data, and T6 is a trailing 6 months. And usually it's accounting for your balance, not your balance sheet, but your income statement, not your balance sheet. So, all right. So what is the reason you like copper? What made you like it? Or
I like it.
what's
Yeah, typically just because of the fact that it does what I wanted to do, which means that it keeps all of people's information. I can actually have a column where I'm taking descriptions, and then I can tag tasks, and it'll send a reminder to my phone. So if I am emailing someone on my computer, my account's linked to my CRM, so their email immediately goes in, and it takes the information that I sent an email to so and so on this date, and then I can go and reference that email and see what we talked about. And then usually what I'll do is I'll go in and see that email, and I'll tag certain things from the email, like, oh, like daughter has a soccer game next week, make sure to comment on that. Or your wife's name's Angela, make sure to comment, you know what I mean? So just taking tags from emails, and it's all in one spot, and it connects to my phone. And I can also get, if I'm in a meeting and I show up to the coffee shop and I don't have my laptop and I forgot all the guys' information, well, I can pull it up on my phone, and it links, and then that's how it goes.
That's smart. What type of email are you using, or do you just use like a Gmail?
I use Gmail, so I have G Business or G Suite Business, and it's Kyle@KyleMarcotte.com.
It's kind of like what?
It's Kyle@KyleMarcotte.com.
Oh, okay.
Yeah.
Yeah. All right. Let's see what other questions we have here for you. There's a lot.
Yeah, there is. I actually kind of want to say something to this guy. What problem did he overcome? Overcoming problem number one would be the age. Everyone's saying that you're too young, and have you ever done this before, and having no experience. It's definitely a difficult obstacle to overcome. But now that I've overcome it a little bit, it's actually kind of becoming a big strength of mine, because of the fact that, when someone says that I'm 21 and I have 119 units, it sounds slightly different than if I was, say 50 or 60 and had 119 units. So I'd like to just say that if you feel like you have a really big weakness, I think that you can actually turn that into a really big strength. Like, for example, this guy, Kevin DK07, said, I'd love to learn more about financing and money, but I'm dumb and bad at math, right? So that's actually not true. That can become your greatest strength. Since you're not naturally gifted in math, you're actually going to have to work harder at it, understand it more than someone who gets it naturally. So math could actually, in the long run, become one of your greatest strengths, because of the fact you genuinely had to learn it. You couldn't take shortcuts. You had no natural talent. It can become your best thing. So I think you just need to kind of look at what you think your greatest weakness is, and just kind of start going after it. It can honestly become, I think it's kind of hidden that way on purpose, just to make things more interesting. I don't know, but that seems to be how it goes in my life.
It's very true. Yeah, very true. Let's see what other questions, and I don't want to block you, so I'm going to look at them here. What financing problems did you run into, meaning with banks and lenders?
Yeah, so banks and lenders right now, the problem we're running into right now on the 9 unit is the bank actually wants the entire first year's mortgage payments in an escrow account, and that doesn't contribute to our first year mortgage payments. It's just being held there. So we still have to pay the mortgage year one, right?
Wow.
But we just have to hold it there, right? So that's kind of where we're pumping the brakes in the deal, because lending's getting a lot different. And yeah, that's definitely a big thing. And then also just people changing rates late, or a new month of the financial data coming in and the bank reassessing and kind of holding things off. And even late in closing, they kind of at times can do that. It's great to get a rate lock, but sometimes that's not always an option, and things can kind of change, especially on the like yield maintenance or step down. If you're doing one or the other, sometimes they'll flip that on you at the last second, which can change the deal a little bit too. So banks are always a little bit finicky, but you just got to work with them and stay up on them as much as you can.
Yeah, that 1 year upfront of loan payments that don't even count towards your loan payments is a large deposit. It's a very large deposit.
Yeah, and their words were, if the economy improves in 6 months, we'll release some of it. I don't know, like on what basis.
Yeah,
I don't even know.
According to what? According to who? Right?
Yeah, exactly.
Now, are you using Fannie and Freddie for your loans?
Yeah, typically. On the Austin deal, we're thinking about using a community bank because one of my partners has a good relationship with one. But I typically go with agency just because of the non-recourse aspect of it. and non-recourse is the thing that we could talk about as well. It's not necessarily non-recourse, right? There can be repercussions on someone who signs on the loan if there's a void in some of the clauses that are in there. And if you read some of the clauses, they can be a little bit finicky as well. So if you're telling someone they're going to sign on the loan and they have no risk, that's actually not fully true. You got to educate them on exactly what non-recourse and what can void it and things like that.
Mm-hmm. All right. Let's see what other questions that they have.
What would you say?
All right. This is. I'm sorry.
Go ahead. Which one were you going to use?
All right. It says, how was he able to get a good deal without being a real estate agent?
Yeah. So this is actually great. You don't need your real estate license, guys. You don't need it at all. Just team up with good brokers in commercial real estate. Just try to find good brokers and they can be a team member and they bring you the deal. So the whole 2 biweekly strategy that I'm talking about is I'm reaching out to real estate agents, or brokers is the term in commercial, and they're bringing me deals. And then they obviously make commission on the deal. That's how they're incentivized. And I'm incentivized by closing and actually, making them realize that commission. So there's a give and take there. But yeah, you don't need your real estate license. It doesn't get you any more access than if you were a broker. Maybe if you work in the office with them, that might be a benefit, but you don't need it. You definitely don't need it.
All right. Let's see what else we got here.
What do the rich do with their money? I kind of want to, oh yeah, let's see this. How do you negotiate?
This one is, I think it's very basic, but I think it's very important.
Yeah, so how do you negotiate the real estate agent percentage? So I'm assuming they mean the commission on the back end. On commercial deals, the bigger it gets, 3% no longer makes sense for the amount of value that they're getting. Typically it's 6% if they're doing both, they're working both sides of the table. But on commercial, let's say you have a $10 million deal. If you give that person 3%, their job doesn't necessarily, that doesn't really make sense, right? So there's a cap, there's a cash amount cap on some of the bigger commercial deals where you say, okay, your commercial is no longer on a percentage basis. It's capped at, let's say, 200 grand. So you're not going to make more than that on a commission. And that negotiation process is give and take. And, you have to, manage that. It's always a difficult negotiation, right? Because the person wants to make money. Obviously they want to make the most amount of money they can. And they definitely do a great job. I think agents are important. You should definitely, make them feel like they're worthy and giving them as much money as you can. But you definitely don't want to give someone 6% of a $10 million deal for just being the broker. You kind of want to cap them at some amount. And typically slightly under 200 grand is usually totally fair. I mean, that's so much money for someone to be making as a broker. I mean, you know what I mean? Like, you should be happy with that. And usually it's not too hard of a negotiation. But sometimes they want to be slightly over 200 grand. And that might even be for such a personal reason as they have a car in mind they want to buy or something. And you got to limit their expectations on that end too. So it's always just a case-to-case negotiation.
Good point. And I wanted to answer that question because a lot of times the questions I'm getting are involved of a very limited and there's not enough out there type of mindset where they want to say, how do I cut this person out? How do I cut the other person out? How can I keep everything to myself? Kyle was not able to do 119 units in 1.5 years by himself. He had to give up something to other people along the way, to his partner, to his investors, to the property management company, to all these different people involved, to the brokers that are bringing him the deals. If he contacts a broker twice a week for a year and then says, I'm not going to give you all the commission, he's not going to get another deal. No matter how many times he calls him, he's going to get blocked. That's what's going to happen. It's a team game. You got to remember, everyone needs to make money in this game. And if everybody makes money, everyone's going to win. But if you're trying to be greedy and save a little bit of money, that means they're not going to want to work with you again. And you're not going to go far. You're not going to go far. You might not even make your first deal happen because you're going to end up upsetting someone that's giving you a good deal. To add to that is this. When you're beginning, a lot of times you don't even know what's a good deal. So someone could be doing you a favor and you don't even know it. And at the end of the day, you can actually be upsetting someone that's actually trying to help you and burning a bridge. So be careful and definitely pay everybody what they're worth. Eventually, you'll figure out who's good and who's not, and that just takes some time.
Mm-hmm. Yeah, it's definitely a long game. And I think that goes back to what you said earlier, which is greedy people typically aren't the ones who are successful long term, because it's not even about this deal. It's about the 10 deals you're going to do over the next decade with that person. So you want to make sure that they're incentivized.
Exactly. So it looks like there was a question that you wanted to answer that you saw, Kyle. Do you remember that one?
Yeah, let me try to figure it out. Let's see. Uh, what do the rich do with their money? Yeah, that was the question. So this is a great one. I think that the difference between the rich and the middle class and the poor is that the middle class and the poor, they save money. They just save it. They have a stash, and that money loses. You're actually losing money when you have a stash, especially with inflation right now. So, the rich invest. So it's always when you have like, some sort of money from a windfall, don't just save it or buy, a new car or upgrade to a new house and buy a liability. A liability is something that takes money out of your pocket on a monthly basis. So a car payment is a liability, right? Because now you have to make that $500 a month. Otherwise, you can't pay your car payment off. You get repoed. And same thing with a mortgage, right? You have to make that $1,000 mortgage payment a month. So you better keep working the same thing that you're doing, and you're kind of shackled. So the wealthy make sure that they buy things with their savings. They buy things that are going to put money in their pocket. And then once they get enough of that going, that snowball where the things that they're buying are paying them so much money on a monthly basis that now they go buy the car, but they buy it with the cash flow from one of the assets that they bought. So it's not, they don't buy it from their earned income. So if I make 50 grand at a employee job, I don't go spend my 40 grand, 40 of that 50 on a car. I go and spend 40 of that 50 on a house that eventually pays me enough money for that monthly car payment. So it's just you're skipping a step in the middle class. The rich don't skip the step. They're a little bit more patient. That's the main difference.
Exactly. Dividend stocks. Yeah, you could try to do that with the dividend stock, but you're never going to make enough money for it to make sense. I have a video that I put out like 6 months ago on my IG account, and it said I got an I-8 for free. Well, what I did is I bought a duplex, remodeled it. The money I bring in from the duplex is like $3,000 a month, and I net that, and I use that to make my I-8 payment, which is less than half of that amount of money. Mm-hmm. So it's the same idea. If you try to do that with dividends, you're not going to put like
yeah, you don't have the control. They may not even release the dividend that quarter or that month, and sometimes dividends are on a yearly basis, so or a 6-month basis. So with real estate, you have the control, and it's more liquid. It's a better situation for you to be flexible.
Yeah, and like the other big part is like, see, your returns are very similar to mine, and that's why I was like trying to clarify the questions earlier. 8% annually to offer to your investors, that's a lot. Normal stock market return dividend is going to be like 2% a year, 1.5%. So when you're offering 8% to your investors, you're doing a great service to them, and now they can afford to do the things that we're talking about.
Yeah, and that doesn't even factor in the tax benefits, right? So you're not even factoring like that doesn't even factor in the depreciation in stock market. After taxes and everything and fees, it does get down closer to that lower percentage. But with real estate, not only are you making that actual 8% that's liquid in cash, you're also saving massive amounts of taxing on your earned income that you're making annually.
Exactly. It's and when you're talking about professionals like doctors, lawyers, any professional that has a high that earns a high W-2 amount, right? They're between Social Security, Medicare, and income taxes, they're paying like 40%.
Yeah.
When you add in all of that. So if you can take and you can write off $10,000 a year, they just earned another $4,000 in tax savings. So it is a great net benefit that people like. One of the things I explain to clients is that how does GE legally not pay any taxes? They're a billion-dollar company. They make billions of dollars a year and they don't pay any taxes. Amazon, the same thing. Because they comply by the rules, and because they comply by the rules, they get the benefits of it.
Exactly.
So guys, we're coming close to the end. We only have about 9 more minutes, so ask your questions. We got Kyle here. He's throwing out lots of diamonds, lots of gold. I mean, this is stuff you got to remember. Take notes. So what else do you have for them, Kyle?
Let's see. Thoughts on going to college? I think that's a good thing because I did drop out of college, and some people think that I'm going to be very anti-college, but I'm not necessarily anti-college at all. I think that college can be a great experience. It's more about the experience than it is, I think, the education. Education, you definitely do get a good education from college. I'm not going to lie, I definitely learned how to learn in college, which was great. But the thing is, you can now in modern society, you can get a pretty decent education from the internet and from, buying books on Amazon and things like that. So if you can't afford college or it's just not an option for you, don't feel bad about that. You can completely make this work without college. But if you're in college right now and you see me and you're like, oh, yep, screw college, I'm out of here. You don't have to do that either. College can be completely, hugely beneficial. Like a lot of times you see the memes of like, this many guys dropped out of college and now they're billionaires. Well, it's like, yeah, that's like, a 100th% of the successful people. Like there's so many people who went to college and were millionaires and billionaires. Like, so don't think that college is bad, but also don't think that you have to go there either. It's just, it's a different route. It's just a different path. It's not better or worse.
Exactly. So actually I have, I had a question okay. So when you're doing your deals, this is my question. When you're doing your deals with your, investors, are you actually creating like a joint venture type of like partnership, or are you actually going through the route of creating an actual syndication where you're registering with the SEC and paying that $25,000 and all that?
Yeah, so it is a legitimate syndication. It's through the SEC. It's Regulation D 506B, not 506C. So for the difference for people listening is 506B is you can invest with people who are not accredited investors. An accredited investor is someone who has $1 million net worth or makes $200,000 a year. So we can take sophisticated investors, which are people who are not accredited. We can take 35 of those people in a deal and then an unlimited amount of accredited. Whereas C, you can take accredited investors, but you can't take non-accredited. And then the benefit of C is you can advertise on social media, whereas I technically can't advertise a deal that I'm working on right now. I couldn't tell you the returns. I couldn't solicit you as an investor on social media or on anywhere on the internet unless I had the actual term is pre-existing and substantive relationship. So this is getting into the legal weeds, but you are dealing with the SEC here. So you have to kind of understand your legality, I guess would be the word. And the fee for the syndication to be set up, it can range from up to 25,000. We actually have someone who does it around 10 out here in Austin. And you can find people who do it for 8. The people who do it for 8 typically have an AI software and they're not as flexible. So if you're doing like a tenant in common agreement on your deal, which is a little bit of a unique situation, then you're not going to probably be able to use the AI people and you'll have to spend money for a real person. And a tenant in common agreement basically means, if this is really getting into the weeds here, but if you 1031 into a syndication, you actually have to get a tenant in common agreement. And a 1031 exchange is where you sell a property and you defer your capital gains tax and you buy another piece of property. So basically, if you sell a house and you buy another house with it, you're not going to pay taxes on that transaction if you do a 1031 exchange. So there's a huge benefit to that, right? Because you're not paying taxes, you're deferring them, which is awesome. But the thing is, to do that into a syndication, you actually have to file a TIC, because to do that, you have to be on the title of the property you sell and the title of the property you buy. So we have to say that they're in common on this title with us, which basically, is a bunch of legal jargon and paperwork. So, but yeah, it's a real syndication, to answer the question more simply.
Yeah, and it's extremely. You have to be very careful when you do a tenant in common. You have to be very careful. Okay, like another level. So I would not he took a lot of time to do this. It's not advisable to do a 1031 exchange into a syndication with a tenant in commons.
Yeah.
It is like he chose literally the hardest group of things to do at the same time with a good deal, but a risky legality. Legality.
Exactly.
So,
the only reason we did it was because that person was bringing a substantial amount of money. So the deal didn't necessarily work without them, and we had to vet them legally. And yeah, man, it was a headache. I wouldn't recommend it to anyone really, especially on the first deal. But it definitely, it's ended up working out. But it was a lot of legal paperwork, but it educated me really well on the topic because we got so into the weeds there.
Okay, so just to go over again, did you say Reg D or Reg C?
Reg D 506B. So it's 506B is underneath the Regulation D.
Okay. And that's $200K or $1 million.
Yeah, accredited investor. So with B, I can accept unlimited, but I can also have the value of accepting people who don't meet those criteria.
All right. All right. So Tom says, how did you learn this? How did you suggest others to learn?
So I actually have a resource guide on my website at kylemarcotte.com. You shameless plug, but yeah, I mean, I learned all of this stuff from podcasts and books and other, YouTube research and things like that. A great podcast would be the Best Ever Real Estate and Advice podcast by Joe Fairless. And his book, Best Ever Syndication book, was a great book to learn a lot of this weed stuff. Because you really do get into the weeds when you're doing some SEC. It's basically, the way you think about it is you're basically getting a permit from the SEC to do this. It's not actually a permit, but that's the easiest way to explain it. And basically they're saying it's okay for you to do what you're doing, but you got to get that cleared with them. And it's it's bureaucracy like you wouldn't believe. So you do have to kind of understand what's happening. And I honestly learned that just from books and podcasts. I actually studied medicine in school, so I didn't study business or real estate. I got all of this from the internet.
Awesome. Very inspiring. So Tom says, what podcast? You said Best Ever podcast?
Yeah, Best Ever podcast. Whitney Sewell, his The Syndication Show. And then you also have, Bigger Pockets, obviously. And then Michael Blanc's a great resource. Rod Khleif is a great resource. Who else is a great resource? Man, there's a lot. I mean, if you keep going down this rabbit hole, you'll find like John Kasman, Target Market Insights. It's another great podcast. So if you really just go out and even if you type in real estate podcast on Spotify or Apple, you'll find some great ones for sure. It's definitely worth your in between time when you're walking to work or driving to work or doing something like that.
So how would you compare, say, the Best Ever Real Estate podcast to the Syndicator podcast? Like, what are the differences between the two, in your opinion?
Yeah, so the difference between the two, syndication show, it focuses purely on what I just talked about, which is real estate syndication. It does start to talk about the SEC stuff and it kind of can get more into the weeds, whereas Joe Fairless does talk about syndication for sure, but he talks a little bit more about general real estate, and he has a podcast every day. So he's, you when you have that volume, you have to get a lot of guests. So those guests can't necessarily all be in one niche. Otherwise, you wouldn't be able to get that many. So he has a wider spread. But the syndication show, if you're interested in what I do specifically, it just talks about that only.
Very good, yes. Have you ever listened to the Real Estate Guys?
I haven't actually, no.
I like that podcast.
I'll check it out. I'll check it out
yeah,
for sure.
Definitely. It's a good one. They've been doing it for 20 years, I think.
Wow.
20
yeah,
years,
I'll definitely check it out then.
Yeah, so they're definitely really good. And I'm actually going to go to their, they're having a cruise. They have a cruise every year.
Oh, wow.
I think the minimum or the cheapest room they have for a new real estate person, that's like under 25, I think it's like $4,000 or $5,000 for the cruise. It's like 10 days. An average person, I think, is like single person is like $8,000 for the cruise. But if it's two people, it's like $17,000.
Is that price going to go down with all this coronavirus stuff?
We don't know. I hope it doesn't stop, because the people that they have on this cruise is like sick, right? Imagine Robert Kiyosaki is going to be on this cruise for the 7th time.
Oh, wow.
And he's speaking at the event, but for the rest of the time, he's on the boat.
Wow, yeah, it's huge.
And you're on the boat with him,
Yeah, no,
so you can have a few drinks,
Yeah,
and
awesome.
and there's a lot of different names in the game that are going to be on that cruise too. So I'm really hoping it happens.
Wow.
I'm really hoping it happens. So
yeah, me
if
too.
we go, I'll
awesome.
be on that cruise too.
Yeah, send me the information. DM it, and I'd love to check it out.
Will do. Well, guys, it's our time. I want to thank Kyle for coming out and telling us what's possible, showing us his success, what he's doing, and the direction he's going in. Just keep on learning and studying and working. Neither one of us came from rich families. We all had to figure it out along the way, and you guys can as well. Kyle, is there anything you'd like to say before we sign out?
No, just thank you for having me, man. It's been a lot of fun.
Awesome. Well, everybody, you have a great night. Be blessed, and I'll see you guys next time.